Welcome to Market Crash Money. In today's video, I wanted to share with you what took place, and today was actually quite an important day. The legendary Sohn conference took place, and I've actually participated in a few of these conferences. I wasn't in today's conference, but I paid close attention to what was going on. And this is a type of investment conference where you would see a ton of hedge fund managers basically get together, and a few of them will be given an opportunity to present the best ideas of the year. So if you stay for the end of the video, I will share with you specifically what those ideas were that were presented, specific stocks and ticker symbols, both on the long side and the short side. Now, in the meantime, I wanted to bring to your attention what was said by the so-called new bond king, Mr. Gundlach, who is managing a $12 billion fund. And typically when he speaks, the markets listen. I'm not sure if you were by your computer, but his presentation started at 2 o'clock. And if you were sitting in front of your screen trading, you probably noticed that between 2 and 2:30, the market just started selling off. And that is because of some of the comments that he had made in his statements, particularly about the economic cycle and the chances of the upcoming recession. So here's a fragment of the video specifically talking about this. Check it out. I hope you enjoy, and stay for the end to check out the rest of the trading.
So visibility is maybe 6 months on recessions, but I do think we could see one potentially in the first quarter of next year. I'm not predicting that. I'm just saying it wouldn't be that unlikely given the length of this economic cycle,
right,
given that interest rates have been rising, given that the stock market is wobbling compared to where it was in the fourth quarter of last year. I mean, these things are giving us things to think about.
You don't think that the new tax law has expanded the cycle or extended it?
I think that's pretty much priced into people's thinking, that narrative on the tax situation. So it probably does extend it. That's probably why we are now challenging the longest expansion in the post-war era.
Oh, in other words, things might have
maybe
moved
it's
up.
already happened. Oh, yeah. I mean,
yeah.
Some of those things.
What do you make of, you talk about recession, people look at and I obviously want to talk about rates with you, not necessarily just energy, the 210 spread. People look at that and they say, what's up with that? Is that telling us something we need to be worried about?
Not yet, although it was getting a little skinny a week or so ago when it got down about 42 basis points. 50 is a level that's, once it gets breached, it does start to give pause, because historically when you go through 50 basis points on 2s, 10s, you generally at some point go to zero. You go flat. It's pretty unusual. You don't go to 50 and then go back into a steepening cycle typically. Now, there's a lot of caveats in this cycle. There's been so much manipulation with quantitative easing and negative interest rates overseas and the like. It's possible that past behavior won't exactly be prologue for what's happening. So, for example, in Japan, they had very, very low interest rates, still do for a long time. They had sequential recessions without an inverted curve. Mm-hmm. Maybe it has something to do with rates being so low, that when rates are very, very low, will the curve really invert at all? Because I can see why, if the 10-year yields 8 and the 2-year yields 8.50, I can see why people would still buy the 10-year. You're getting 8, which satisfies a lot of investment needs. But when the 10-year is 2.75, which it was, and the 2 years down to 2.25, I don't really think it's that exciting to pick up 50 basis points to take that amount of rate risk. So maybe the curve won't invert this time. But it is telling us certainly that, that there's something to start looking at for recession warning.
What do you make of the 10-year in and of itself? I mean, here we are knocking on the door, about to bust it down at 3.
Yeah, we got
then
to 2.994. Well, I've been of the opinion that closing above 3 would lead to an acceleration to higher yields. And we have not closed above 3. And the other big level, I think it's even bigger, is 322 on the 30-year, which we did close at. That was the high close this year, and then we backed off pretty nicely. But now we're back up to 316, 317. We're getting close again. So I think breaking above 3 would be the same as breaking above 322 on the 30-year. But what's interesting is the most recent rate rise, off of 272 up to 299 this morning. It's hard for people to come up with why it's happening. And it's like the bond market is kind of chronically weak in recent days. And I'm reminded of the old adage that you need buying to move prices up, but prices can fall of their own weight. And I think it has something to do with all this bond supply and these deficits that I've been talking about now for about 18 months. It's now here in real time. I mean, we're borrowing like $100 billion a month, you know, and that's kind of a lot. So I think that there's a lot of negative positioning against the bond market. So you would think that maybe it'd be stubborn to go to higher yields, but prices can fall of their own weight. It looks to me like the shorts have not covered.
You worry at all about the Fed making a policy mistake?
Of course. The Fed is back into a variant of their old school mode where 10, 12 years ago they were hiking at every meeting. And they do it until something breaks. Now they're doing it once a quarter, but they seem inclined to do it until something bad happens. And don't forget, they're doing it at the same time that we're ramping up quantitative tightening. So we have this double-barreled Fed thing, and I think that that is something to be worried about. The Fed has gone from a mode of we will raise rates when the data gets better to a mode of we will raise rates unless the data gets worse. And so that puts them into that kind of semi-autopilot mode, which in the past has led to problems. And certainly the 2-10 spread that we talked about a moment ago, that certainly isn't giving a warm and fuzzy feeling about what the Fed is doing. It might not be on the cusp of a big mistake yet, but it's not acting in a way that I think the Fed would find, reassuring.
Let me lastly ask you about the other investment idea you had, short Facebook.
Right.
Really?
Yeah, really.
Where did that come from?
Well, it came from, I was long the energy thing, and I didn't want to be full-on recession exposed in my pick. And so I wanted something to short against it, and I saw the congressional testimony, which I thought was terrible. I thought it was dismissive. I thought it was insincere.
By Zuckerberg?
Yeah. I thought that he was very semantic in the way he was answering questions as opposed to fulsome. And one of the charts I used on stage today, once the regulators show up, they tend to cause problems. There's basically two modes of regulation by Congress, none and overreaching. And I think we've moved from none and we're about to move into overreaching. And I used a slide that when they started to talk about regulating biotech companies, for example, the stocks just started tanking. And Facebook dropped. It hasn't tanked. I'm actually happy about that because it leads to a better position for this recommendation. But I'm reminded, I used the metaphor of the San Francisco earthquake in the stock market. The day after the San Francisco earthquake, the legendary investor Jesse Livermore shorted the market because he couldn't believe that the market was actually unchanged. And he said, this is a big event and it hasn't been digested into the bullish psychology of the market. I think the regulation here is a big event. And I also think that there's never one cockroach in the kitchen. So we've had this apology tour. We've seen it before. This isn't the first apology tour. I think we're already one apology too far on this thing. One more problem, and there's going to be one because there's never one cockroach. I just don't know what will happen with the credibility of these I'm sorry, we're going to make it better type of statements. And I don't find it reassuring that one of his answers was AI is going to solve our problems 5 or 10 years from now. This problem began yesterday, not 5 or 10 years from now. And so I think that there's I think there's going to be a lot of turbulence in the air for this flight.
All right. We will we'll see how the plane gets through it and see if it lands well.
We'll see.
Jeffrey, thanks so much.
Thanks for having me.
Appreciate it very much. Jeffrey Gundlach is the founder.
Okay, as promised, here's a list of stock ideas that were presented during the investment conference today. Number one was Grub, and it went up immediately by a few dollars as the idea was presented. So did Box. Box shot up straight from 20 to 23.5 within a matter of a few minutes. Palo Alto Networks, PANW. On the short side, there were two ideas. Clearly one you just heard about was Facebook. Nothing new there. And a very interesting idea by legendary David Einhorn, AGO. Now that one dropped from 36 to 34 as the idea was presented. Now you're probably wondering, well, is it too late for me to jump on board on some of these ideas? The reality is, depending on whether you're buying stocks or shorting stocks or whether you're trading options, and what is your time horizon. So if you are interested in finding out specifically which one of those ideas still have room to run, or is it really too late to get on board? Simply visit marketcrash.money and get the answers to questions like this by clicking right here on How to Profit button. Now, obviously, the entire world now knows about these trading ideas, and maybe you're looking for some ideas that are not known yet to the general public. If this is the case, if you're maybe struggling generating some new ideas as a trader, if maybe you're trying to come up with some new strategies for this crazy market environment that we have been recently going through, definitely click the How to Profit button, schedule your one-on-one coaching training session. I have a simple 5-step method where I am showing you how I took $12,000 and turned it to $460,000 in less than 7 hours. It is a personal record of mine. However, the underlying foundation and the strategy utilized in that day apply to many, many market conditions, especially like the ones that we experiencing today. So if you'd like to become a better trader, regardless whether you're brand new and just getting started or you're an experienced trader that's been trading for years, click right here, How to Profit. Don't waste any time. Take action now and make 2018 your most profitable year ever.